A couple days ago on Friday, the FFIEC report came out about 10 minutes before we were going to hop on the SoFi Weekly podcast. This report is a public record of bank filings, of which SoFi Bank is a part of. This comes out every single quarter, and due to the timing of these releases, investors who are paying attention have the opportunity to learn about SoFi's bank numbers ahead of the actual earnings report. Now, this has been the case for the past several quarters. However, we don't know exactly when the report is going to come out. On Friday, we only had about 10 minutes prep. We did our best with the numbers that we had in real time as we were digesting them. And in the process, we got some of those numbers wrong. However, over the weekend, there's been great research by multiple sources, and I wanted to compile them in this video and give you a full breakdown of the FFIEC report for Q2 with regards to SoFi's bank earnings. I'll start this video off and give credit where it is due. This video is primarily compiled of two main sources. The first one is Chris Hoeger on Twitter. He goes by @DataDrivenInvesting, who made a 5-part thread breaking down the FFIEC report. If you're not following Chris already, I highly recommend it. He's one of the best SoFi retail investor analysts out there. And yes, I did call him an analyst. The second source we're going to be drawing from is Vadim, who is a part of the SoFi community, who also made a Substack post breaking down the FFIEC report. Vadim's also a constant contributor in the community who has really great due diligence on SoFi in general, although is less frequent with regards to posting a content. And if you're a retail investor following SoFi, both of these individuals you have to follow for in-depth analyses and breakdown. All I'm doing in this video is simply aggregating some of their findings in audio format and summarizing some of their numbers in my own words. So full credit goes to them. Both of their links, including the breakdowns that they did, are attached in the description below. Now, both of these individuals broke out their findings in terms of section categories. And so in this video, I'll start off with deposits, talk about non-interest and net interest income, gap earnings, and also some interesting findings with regards to credit loss provisions and Wyndham acquisition, and just in general, what other tidbits of information we found. So let's jump into it. First and foremost is deposits. Now, the first thing to note here is highlighted by Vadim in his article. SoFi bank reports and SoFi earnings reports are not always comparable because there's always different contributing factors such as warehouse lending or intercompany transactions or a whole bunch of other criteria that we have to account for. And this discrepancy is seen when we compare the differences in the FFIEC report, which was released on Friday, and the differences in SoFi's earnings report, which we're going to get on Monday, meaning that these numbers are not going to always be a one-to-one comparison because there's other factors that go into them. Neither the deposit numbers themselves nor the deposit growth numbers actually match up. The deposits in the FFIEC report on Friday are often higher than the reported quarterly numbers. As a result of this, a discrepancy was noted last quarter between the FFIEC report deposits, which was $3 billion, and the quarterly report increase, which was $2.75 billion. The reason for this discrepancy between these reports is not really clear right now. On the SoFi Weekly podcast, we said that we were expecting $3.2 billion in deposit increase. According to Chris Hoeger, this might be overestimated, and in fact, the real number could be closer to $2.87 billion. In fact, both Chris and Vadim, in their analyses, estimated new deposits for Q2 to be around 2.5 to 3 billion, bringing total deposits to around 12.5 to 13 billion. In other words, both these individuals said that deposits was likely going to come in lower than the 3.2 billion we highlighted on the SoFi Weekly podcast on Friday. Still, I think any number within these ranges above 2.5 billion, 2.6, 2.9, 3 billion, all of these are very positive. So I'm still pretty happy with that. Moving on to net interest income. Now, again, due to SoFi's diverse business structure, there's differences that exist in the reporting. SoFi has their bank segment, they have their lending segment, they have SoFi Securities, they have Galileo, they have all of these different businesses. They're seen almost as a conglomerate, as Chris Hoeger put it. Some of the things that are in the FFIEC report are broken out differently as a result of this. For example, credit card interest is included in the report, but not in SoFi Lending's quarterly report. So basically, line items will appear differently on both of these reports. The other thing to keep in mind is that the FFIEC report, which was released on Friday, is year to date. As I mentioned in my video after the SoFi Weekly podcast on Friday, as a result of this, what you have to do is you have to subtract the first quarter numbers to get the differences. And by doing so, Chris highlights in his report that there was a significant increase in net interest income, rising from 184 million in Q1 all the way to 247.7 million in Q2. This is the biggest increase in net interest income that we've seen to date. However, Chris highlights that SoFi is to some extent cannibalizing their warehouse lines of credit with deposit growth. And what this does is it leads to higher bank net interest income versus SoFi lending net interest income. Now, the gap between these two segments is narrowing every quarter. So far, lending segment net interest income has always been higher than bank net interest income, but this is quickly changing. Okay, so if you're confused at this point, let me take a step back and try to break it down. So SoFi Bank and SoFi Lending are two different divisions within SoFi. SoFi Bank's net interest income is growing faster than SoFi Lending's net interest income. And this is as a result of the bank earning more from customers increasing their deposits, from deposits going up, basically. Meanwhile, SoFi Lending, which used to rely on warehouse lines of credit to fund its loans, is now using fewer of these because of the growing deposits in SoFi Bank. So as a result of this, this leads to lower net interest income for SoFi Lending and higher net interest income for the bank due to those deposits, right? So the really simplified version is simply to say that the growing deposits that we're seeing on SoFi Bank is leading to a change in the net interest income distribution between the bank versus the lending side of SoFi's business. Okay, let's move on to part 3, non-interest income and non-interest expense. Non-interest income now, it includes variables such as loans sold, gains on loans, value fluctuations, and interchange fees. This actually went down quarter over quarter from 174 million to 127 million. Now, obviously, this is not great. However, the correlation between non-interest income in the FFIEC report released on Friday and the lending segment is not consistent. And we know this is not consistent because there's been inaccuracies in the first quarter 23 predictions, which were caused by a $38 million swing in revenue from the FFIEC report to the quarterly report. And this really makes it very difficult for us to accurately track non-interest income. Vadim also had a section in his Substack article on non-interest expense, where he looked at some of the line item expenses, including sales and marketing spend. Some of the main conclusions on these findings was that in the first quarter of 2023, most of SoFi's marketing and admin costs were from the bank expenses. So they had $117 million in expense due to SoFi Bank out of $175 million total S&M spend. In Q2, however, the bank's non-interest expenses increased significantly due to marketing, administration, credit loss provision, salaries, and amortization. Vadim concluded in this section with regards to non-interest expenses, saying that to maintain the same level of net loss as in Q1, SoFi needs to actually increase its revenue by 26 million in Q2. The super simplified version being that the expenses have increased with regards to SoFi Bank. Which leads us to GAAP earnings. Now, SoFi Bank as a segment has been profitable since the second quarter of 2022. However, SoFi as a wider company, which includes the bank, the lending, Galileo, all of the different business segments, is still unprofitable, right? We're still looking for profitability across the board. We know that, the financial services side of the business is unprofitable. The wider business is unprofitable as well. Bank earnings decreased between the first quarter 23 and the second quarter 23, moving from 73 million down to 63 million. However, bank earnings and SoFi earnings trends don't really match perfectly. The difference in net incomes between the bank and SoFi as a wider business has a really big variance from quarter to quarter. And the biggest variance was the $38 million in revenue in the non-interest income section that we just covered. So we'll see what SoFi reports tomorrow on the GAAP earnings side of things. And overarchingly, I think the theme of this has been that the FFIEC report and the SoFi earnings report is not a one-to-one comparison. However, Chris does highlight that there's two things that track extremely well from both of the reports, which we can get some more insight from. The first thing is provision for credit losses, and the second is mortgage originations and the home loan sales. Now, according to Vadim's research, SoFi set aside $41 million to cover potential loan losses, and this number has been up from 38.9 million in Q1. In Q1, SoFi wrote off $10.3 million in bad loans, but only provisioned for $8.4 million. Whereas in Q2, SoFi wrote off $10.5 million, but provisioned for a higher amount, $12.6 million. So basically, SoFi's loss in provisions in Q2 is $12.6 million, which is $4.2 million more than in Q1, right? From the 8.4 to 12.6. And what happens is this quarter's 12.6 million provision for credit losses is going to be deducted from SoFi's GAAP net income. So let me just take a step back again and explain in simple terms. What this means is that SoFi has increased the amount of money it has set aside to cover potential losses on loans, which indicates that they're expecting to have more losses on loans than they did in the previous quarter. Because in Q1, SoFi had written off more bad loans than they had anticipated. So they had to cover the difference with their own funds, right? They wrote off 10.3 and they only provisioned 8.4. There was a difference there. Whereas in Q2, they were more conservative and they set aside more funds for potential loan losses than the actual loans that they wrote off. This could suggest a cautious approach due to an expected increase in loan defaults or just a more conservative strategy with regards to their credit loss provisions overall. SoFi's losses due to these provisions are higher in Q2 by 4.2 million, right? This is the difference to take them to 12.6 from 8.4. And the reason why this is important is because loan loss provisions can significantly impact the company's net income and as a result, its profitability. And finally, the second point that tracked very well in both reports was mortgage originations. For Q2, SoFi saw originations of 243 million and loan sales of 245 million as per the FFIEC report. And Chris concluded in his analysis saying that the purchase of Wyndham Capital had resulted in a 150% increase in originations compared to just last quarter, which is obviously incredibly bullish to see. And one thing that I am expecting to see tomorrow is them talking about how Wyndham is really going to help them moving forward. Just to conclude this video with another reminder that there's going to be big differences between both reports and that there's some areas that are more comparable than others and other areas that are not as comparable or we can't draw as much insight. It's important for us to remember that SoFi is much larger than just the bank side of their business. And there's only so much information that we can reasonably deduce from the FFIEC report. However, both Chris and Vadim have done an amazing job breaking down the numbers and reading both of their analysis. I felt the need to make this video to summarize some of the main findings so that everybody has the numbers leading into Monday. One of the key takeaways is for me to urge caution, as some of the numbers that Chris and Vadim highlighted are more reasonable and more grounded than a lot of what we were saying on Friday when we had the numbers just gut response. So I also felt the need to make this video to also correct some of the numbers that we were throwing out on Friday because I don't want anybody to get the wrong impression. I hope you enjoyed this video. All credit goes to Chris and Vadim. Like I said, both of their links are tagged in the description, and I hope you tune into this channel on Monday morning at 7:30 because we're going to be listening into SoFi's second quarter earnings call. I'm going to be taking notes on the call. We're going to have the live price up on the screen and commentary along the way. It's going to be lots of fun. Tune back in on this channel and you'll hear all about it. For right now, this is the Fundamentals Investing Podcast. Thank you so much for listening.